Dr. Babasaheb Ambedkar Open University.
Hello my dear friends and dear student, I am welcoming you to all in the video lecture series conducted by the Dr. Babasaheb Ambedkar Open University in the Chaitanya studio for the course called BBA Regular in the paper number BBAR-202 Financial Management, in that block number 3 Working Capital and Investment, in unit number 1 Working Capital Management, point number 1. While we discussing the financial management and the different source of financial management with the different cost of capital, leverage, etc., the main and the heart is that working capital, that is short-term need of finance, that you have to manage your working capital in efficient manner. On that, this particular unit talks about the working capital management, that is totally theory portion with few practicals that determining the working capital. So first of all, we have to learn what are the different learning objectives are there. So after learning this unit, you will be able to understand that how the working capital cycle operates. Factors which influence the working capital requirements. Then calculate the average working capital requirements. Then enumerate the component of capital structure. Then measures the business risk, financial risk and the total risk through the leverages. Now let's begin our journey for this particular unit to the point of introduction. The working capital is significant in the financial management due to the fact that it play an important role in keeping the wheel of the business enterprise running. It may be regarded as a lifeblood of the business. It is concerned with the short-term financial decision. It effectively, the provision can do much to ensure the success of business, while its inefficient management can lead not only to the loss of profit but also to the downfall of promising concept. A study of working capital is of the major importance of the internal and external analysis because of its close relationship with day-to-day operation of the businesses. Working capital management includes the management of various components of current asset as well as the current liabilities. A firm invests a part of its permanent capital in a fixed asset and keep a part of it for the working capital, that is for the meeting to day-to-day requirements. The requirements of working capital varies from the firm to firm depending upon the nature of business, production policy, market conditions, we can say the seasonality of the operation, condition of the supply, etc. Then working capital management, if carried out the effectively, efficiently and constantly, will measure or assure the health of the organization. Now let's move on to the meaning and definition of working capital. In accounting, the working capital is the difference between the inflow and outflow of the fund. It is the net cash inflows. Working capital is defined as excess of current asset over its current liabilities and provisions. Current assets are those assets which will be converted into the cash with the current account period or within the next year as a result of the ordinary operation of the business. The efficient working capital management require the firms should operate with some amount of net working capital. The exit amount varying from firm to firm and depending among other things on the nature of industries. The greater the margin by which the current asset cover the short-term obligation, the more able it will be to pay its obligation when they become due to payments. Now let us move towards that is types of working capital. First type is net working capital and second is gross working capital. First, that is net working capital, is the difference between the asset and current liabilities. The concept of net working capital enables a firm to determine how much amount is left for the operational requirements. The gross working capital is the amount of funds invested in the various components. Then the financial manager are profoundly concerned with the current assets. The gross working capital provides the current amount of working capital at a right time. It enables a firm to realize the greatest return on the investments. It helps in the fixation of various areas of the financial responsibilities. It enables a firm to plan and control the funds and to maximize the return on investment. For this advantage, the gross working capital has become a more acceptable concept in the financial management. The third type is permanent working capital. The permanent working capital is the minimum amount of current asset which is needed to conduct a business even during the dullest season of the year. This amount varies from the year to year depending upon the growth of the company and the stage of business cycle in which it operates. It is the amount of fund required to produce the goods and services which are necessary to satisfy the demand at the particular point. It represents the current assets which are required on the continuing basis over the entire year. It is maintained as a medium to carry on the operation at any time. Then permanent working capital has the different characteristics also, that it classified on the basis of the time factor. Then it constantly charge from one asset to another and continues to remaining in the business process. Then its size increases with the growth of the business operations are there. Next is temporary or variable working capital. The temporary or variable working capital represent the additional assets which are required at the different time during the operation, or we can say the operating year. Additional inventories, extra cash, etc. The seasonal working capital is the additional amount of current asset, particularly cash, receivable and inventory, which is required during the more active business season of the year. It is temporarily invested in a current assets and the processes of the characteristics. The first, that is, it is not always the gainfully employed. Through it may be changed from one asset to another as permanent working capital does. It is particularly suited to the business of a seasonal or cyclical nature. Next point, that is balance sheet working capital. The balance sheet working capital is not which is calculated from the item appearing in the balance sheet. The gross working capital, which is represented by the excess of current assets, and net working capital, which is represented by the excess of current asset over the current liabilities, are example of the balance sheet of working capital. Next is cash working capital and negative working capital. The cash working capital is one which is calculated from the item appearing in the profit and loss account of the current asset. The negative working capital emerges when the current liabilities exceed the current asset. In such a situation is not absolutely theoretical and occurs when a firm is nearing a crisis of some magnitude. So these are the different types of working capital. Now let's talk about the factors determining working capital. These are the different factors which can be determined by the working capital or affecting to the working capital. In that, first point is nature of industries. Second point is demand of industries. Third is cash requirement. Then nature of business, manufacturing time, then volume of sales, terms of purchase and sales, inventory turnover, receivable turnover, business cycle, current assets, current liabilities, valuation in sales, production cycle, credit control, liquidity and profitability, inflation, seasonal fluctuation, profit planning and control, repayment ability, cash reserves, operationalism efficiency, change in technology, firm's policy, size of the firm, activities of the firm, and attitude to the risk. So, my dear friend, these are the different factors which can be determining working capital and factor affecting to your working capital. Now, let's talk about the operating working capital cycle. The operating cycle consists of 4 stages. In that, first stage is raw material and store inventory stage. Second is the work in progress stage. Third is finished goods inventory stage, and fourth is receivable stage. The operating cycle begins with the arrival of the stock and ends when the cash is received. The cash cycle begins when the cash is paid for a material and end when the cash is collected from the receivables. This particular chart determining the operating cycle. It starts with the cash to raw material, that is purchase of raw material. Then raw material to work in progress, that is issuing the material to production and incurring the different expenses. Working capital to finished goods, finished goods to the account receivable, that is going for the sales, and account receivables to cash, that is collection of receivable. So this is ultimately the chart of your operating cycle working capital. On that basis, the component of cycles, operating cycles, that is gross operating cycle and net operating cycle. The gross operating cycle determine the raw material storage period, work in progress holding period, finished goods storage period, debtors collection period allowed. Thus, we can say that gross operating cycle is equal to R plus W plus F plus D. That is, R stands for the raw material storage period, W for work in progress holding period, F for finished goods storage period, D for debtor collection period allowed, etc. Then net operating cycle, that is net operating cycle means gross operating cycle minus the credit period allowed by the supplier, that is creditor of the goods. That is R plus W plus F plus D minus C. C for credit period allowed by the supplier. That is R, W, F, D, same as per the gross working or gross operating cycle. Next point is working capital requirements. That every firms require at least some amount of working capital, only their working capital requirement are different. The goal of every firm should be increase in the profit of its shareholder. And to achieve this goal, the firm's operation must yield enough return. Successful sales activity is very essential to earn a profit, and hence it is imperative that the firm invest sufficient fund in its current asset for a sale operation, or we can say the sale generation. As a sale cannot be converted into the cash immediately, the current assets are required to convert sale into cash. Working capital is essentially circulating capital. In fact, it is often referred to as such, And this has been admirably summed up, the comparing it with arrival which is there the every day, but the water in the constantly changing. There is a river, the river is a every day, but the water is constantly changing in that manner. Then after discussing the point that is estimating working capital needs and financing the current assets, the operating cycle is the most appropriate method for computing the working capital requirement of any company. However, the method other than the operating cycle for computing a firm's working capital includes, that is, estimation of firm's working capital requirement on a ground of the current assets average holding period, and then relating to them to the company's cost based on the past experiences. The operating cycle approach forms a business, or we can say the basis of this method, and in order to use this method for estimating working capital needs, one can make a certain assumption such as there is a supply of raw material and semi-finished and finished goods for a 1 month. Second is assuming that the current assets are with sales, and the ratio of sale can be used as a method of estimating the working capital of a firm. Here it can be assumed that the annual sale are anywhere between the 25 to 30%. Third point is working capital requirement can also be estimated as a ratio of fixed investment. So these three are the different estimations are there for working capital needs and financing the current assets. Over there, to sum up with this particular video, we learn the concept of working capital. We learn the concept of working capital management. We learn the different definitions of the working capital given by the different authors. The basic meaning in accounting, what is working capital, objective, features, characteristics, then factor affecting working capital, different types of working capital. There are total 7 types of working capital. Then what is the optimum operating working cycle? Operating cycle are there. The gross operating cycle, net operating cycle, etc. Then working capital estimation and need of financing. So these are the different components which can be learned in a working capital management chapter, or we can say the unit. Hope you learn well in this unit. For a further reading, you may refer the different reference books also as mentioned in the previous slide, and you may check out what you learn and what you suggestive for the different types of sources, and what are the suggestions for the different learning approach towards the working capital in a present scenario. In this chapter, we meet in a next session with the different components with respect to working capital, and we sum up this particular unit in a next session or next video. Hope you learn well in this video. Hope you learn good and in efficient manner to the determining the working capital management. Hope you learn well. Thank you very much.